Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everybody. This is Brent Foster in the Northbound Wealth Podcast. Today is July 16th, and let's dive into reviewing last week, and then we're going to talk about the big, beautiful bill. BBB, triple B, the one big, beautiful bill. All right, so last week, stocks were slightly lower last week while looking past news of fresh U.S. tariffs on nearly 24 countries. The S&P 500 fell 0.31%. Friday's session closed at 6,259.75, slightly below record highs it reached a day earlier. The market benchmark hit a new intraday high on Thursday last week at 6,290.22 before ending the day's session at 6,280.46, its highest closing ever. The index is up 0.9% for the month and 6.4% for the year. The NASDAQ Composite Index edged lower by 0.08%, closing at 20,585.53. So kind of wanting to see that fall through by the NASDAQ, the tech space. The Dow Jones Industrial Average lost 1.02%, closing at 44,371.51. The MSCI EFA Index, which tracks developed overseas stock markets, slipped 0.43%. Return of the tariffs, that is the headline. So stocks started the week lower after the White House posted letters to 14 countries announcing new tariffs take effect August 1st. They included 25% tariffs on South Korea and Japan. Stocks dropped briefly midweek after the White House announced tariffs on 7 additional countries. But as investors digested the news, markets gradually recovered, hoping the administration would dial back its steepest tariff rates once again. Markets also rallied on fresh AI trade enthusiasm in the latest Fed meeting minutes, which showed a majority of committee members were open to adjusting interest rates later this year. President Donald Trump Thursday evening said the U.S. would raise its tariffs on imports from Canada to 35% from a prior rate of 25%. Goods that comply with the nation's free trade agreement would be exempt for now, a White House official said, but investors are still concerned by the threat. Trump also warned of plans to impose blanket tariffs of 15 to 20% on most trading partners, up from 10% baseline rate, in an interview with NBC. The financial sector had the largest percentage drop of the week, down 1.9%, followed by a 1.8% decline in consumer staples and a 1.2% slip in communication services. Real estate, healthcare, and materials also edged lower. Markets opened higher on Thursday as investors shrugged off news of the 50% tariff on Brazil imports, announced shortly after Wednesday's close. Momentum continued, and the S&P 500 and NASDAQ rose to fresh records. Then, after Thursday's close, the White House announced the U.S. was raising tariffs on Canadian imports to 35%, was preparing some other tariffs. Markets opened lower on Friday and trended sideways during the trading session. So, Y Charts, thank you so much for this data. I reference your data a lot, so I appreciate it. Weekly Market Insights Major Index Return Summary. The NASDAQ year-to-date trailing number is up 7.22% for the year. 1-year trailing's up 11.41%, and then 5-year trailing number is 101.8%. Dow Jones Industrial Average year-to-date trailing is 5.91%. Year-to-date or 1-year trailing number 14.39% and 88.95% for the 5-year trailing number. S&P 500 year-to-date trailing 7.54%. 1-year number is 12.98% over the past year, and then 5 years trailing number is 112.7%. So the top performer. MSCI EFA Index year to date, 20.44%. So international is outperforming. 1-year trailing number 16.16%, 5-year trailing number 71.54. So it seems like it has a long ways to go to catch up with the U.S. 10-year Treasury note 4.43%. Watching that 10-year trend and tick kind of back and forth between 4.2 and 4.48, kind of oscillating in between there. Thank you, Y charts. The T word. While tariffs drove market headlines last week, another T word made some news, and that is trillion. Okay, so more specifically, $4 trillion in market capitalization. The nation's largest AI chip maker was the first company to breach that market cap level. It crossed $4 trillion intraday on Wednesday, then closed above it for the first time on Thursday. So anybody know what stock that is? NVIDIA. So if you own NVIDIA, you know it because you're up a lot. So why does it matter when one stock hits such a milestone? For market cap weighted index like the S&P 500, a company valued at $4 trillion has an outsized effect on the overall index's performance. The largest 5 companies in the S&P 500 comprise about 1/3 of the benchmark index. Other market news: Progressive was one of the most hardest hit financial stocks, falling 6.4% as Morgan Stanley downgraded its investment rating on the stock to equal weight from overweight. Progressive's prior investment thesis of unencumbered growth and margin expansion is nearing its end amid rising competition and valuation pressures, the firm said in a note to its clients. I mean, it has been a great stock, a great outperformer of even the S&P 500 as of late. In consumer staples, shares of ConAgra brands had the largest percentage drop of the week, sliding 7.6% as the packaged food company reported weaker than expected fiscal fourth quarter results. ConAgra also issued full-year earnings outlook below market estimates amid pessimistic macroeconomic uncertainty and elevated inflation. On the upside, the energy sector climbed 2.5%, followed by a 0.8% rise in utilities. Industrials, technology, and consumer discretionary also eked out slight gains. The energy sector's gains came as crude oil futures also rose. Risers included shares of Halliburton up 7.3% and Hess up 6.4%. In utilities, AES shares added 9.3% amid takeover rumors. The company is exploring its options, including a potential sale of the company due to takeover interest from large investment firms, Bloomberg reported, citing people with knowledge of the matter. Quarterly earnings reports this week, which are JP Morgan. It kicks off with the banks on Q3. Wells, Fargo, BlackRock, Citigroup, Johnson & Johnson, Bank of America, Morgan Stanley, Goldman Sachs, Netflix, PepsiCo, and American Express. There's plenty kicking off the Q3 earnings season, and so far it's been pretty darn good. So that's why the market's still trading the way it is. Economic data will include the June consumer and producer prices indexes, as well as June retail sales, housing starts, and building permits. So this week, we already covered a bunch of companies. All right, so tax tip of the week, besides the one big, beautiful bill. If you have a legal agreement with your child's other parent regarding custody, you may have questions about claiming the child on your tax return and what credits, if any, you are eligible for. It might help if you research the child tax credit as well. So be listening for that in the BBB, big, beautiful bill. The parent who claimed the child tax credit for qualifying child the previous year may have received the advanced child tax credit payments the following year. So this information, again, is not a substitute for individualized tax advice. Please discuss your specific tax issues with the qualified tax professional. And this tip was adapted from irs.gov. All right, stay tuned for the big, beautiful bill in the next segment. Thanks for listening. Hello, everybody. This is Brent Foster, and I'm going to review an article summary written by Alistair M. Nevis, JD, June 29, 2025, updated July 7th after the tax provisions in the One Beautiful Big Bill Act were passed. Below are In this segment, you're going to hear details of many of the tax provisions in the One Big Beautiful Bill Act, which was signed into law Friday by President Donald Trump. The House approved the measure Thursday in a 218 to 214 vote after the Senate approved it Tuesday by a 51 to 50 vote, with Vice President J.D. Vance casting the tie-breaking vote. The bill extends many of the expiring provisions from the Tax Cuts and Jobs Act, or the TCJA, PL 115 through 97. It also addresses other tax priorities of the Trump administration, including providing deductions to eliminate income taxes on certain tips and overtime pay. The bill also revamps some of the TCJA's provisions on the taxation of corporations' foreign income and determines a large number of clean energy tax incentives. In a statement, AICPA President CEO Mark Koziel, CPA CGMA, called the bill a win for millions of businesses, taxpayers, and tax practitioners across the country. Additionally, Koziel said in a statement, "No bill is perfect. However, there are many beneficial tax provisions in this bill that I believe would support the business community and will help grow our economy. The tax provisions in this bill will help facilitate tax planning earlier in the year, which can help reduce the anxiety of the unknown for many taxpayers." The AICPA has published charts comparing tax and personal financial planning provisions of the bill with the current law. And so we're going to look at that. Provisions for individuals here. Tax rates. The bill generally makes the tax rate enacted in 2017 in the TCJA permanent. That's good news. The bill adds an additional year of inflation adjustment for determining the dollar amounts at which any rate bracket higher than 12% ends and at which any rate bracket higher than 22% begins. Standard deduction. The bill makes the TCJA's increased standard deduction amounts permanent for tax years beginning after 2024. The standard deduction increases to $15,750 for single filers, $23,625 for heads of household, and $31,500 for married individuals filing jointly. The standard deduction will be adjusted for inflation after that. These changes have been made retroactive to include tax year 2025. That's now. We're halfway through. SALT cap. So the bill temporarily increases the limit on the federal deduction for state and local taxes, the SALT cap, to $40,000 from the current $10,000. That's a big move, and adjusts it for inflation. In 2026, the cap will be $40,400, and the version of the tax bill that passed the House in May also increased the SALT cap to $40,000, but included provisions to limit taxpayers' attempt to circumvent the cap, including not allowing specified service trades or businesses to deduct state and local income taxes. This provision would limit the usefulness state pass-through entity taxes, or PTETs, in avoiding the SALT cap. The Senate Finance Committee's version of the bill took it a different track and would have limited all pass-through entity owners' deduction to the unused portion of their SALT deduction plus the greater of $40,000 of their allocation to the PTET, or 50% of their allocation of the PTET. The adopted version of the bill merely increases the SALT cap and does not attempt to limit or address the various workarounds that taxpayers are currently using to avoid the SALT cap. The AICPA had advocated against limiting the use of PTETs. Let's see. In the AICPA statement, Koziel said, "We are thankful to the members of Congress who supported millions of businesses' ability to retain pass-through entity tax SALT deduction, and our partners throughout the state, CPA societies, and other professional service businesses for their diligent advocacy on this important issue." For more on this, see Senate Budget Bill would preserve PTET SALT deduction. Okay, so personal exemptions and senior deduction. The Senate bill permanently sets the deduction for personal exemptions to at zero. However, it provides a temporary $6,000 deduction under Section Code 151 for individual taxpayers who are age 65 and over. This senior deduction begins to phase out when a taxpayer's modified adjusted gross income, or MAGI, exceeds $75,000, $150,000 in the case of a joint return. It will be in effect for the years 2025 through 2028. Child tax credit. The bill increases the amount of the non-refundable child tax credit to $2,200 per child beginning in 2025 and indexes the credit amount for inflation. The bill also makes permanent the $1,400 refundable child tax credit adjusted for inflation. In addition, makes permanent the increased income phase-out threshold amounts of $200,000, $400,000 in the case of a joint return, as well as the $500 non-refundable credit for each dependent of the taxpayer other than a qualifying child. The QBI deduction. So the bill makes the Section Code 199A qualified business income deduction permanent and keeps the deduction rate at 20%. The bill passed the House and would have raised it to 23%. The bill expands the Section Code 199A deduction limit phase-in range for SSTBs and other entities subject to the wage and investment limitation by increasing the $50,000 amount for non-joint returns to $75,000 and the $100,000 amount for joint returns to $150,000. The bill also introduces an inflation-adjusted minimum deduction of $400 for taxpayers who have at least $1,000 of QBI from one or more active trades or businesses in which they materially participate. Estate and gift tax exemption amounts. This is important. The bill amends Section 2010 to permanently increase the estate tax exemption and lifetime gift tax exemption amounts to $15 million for single filers, $30 million for married filing jointly in 2026, and index the exemption amount for inflation after that. Alternative minimum tax exemption. So the bill permanently extends the TCJA's increased individual alternative minimum tax exemption amounts and reverts the exemption phase-out thresholds to their 2018 levels of $500,000, $1 million in the case of a joint return, indexed for inflation. However, in a change from the Senate Finance Committee's version of the bill increases the phase-out of the exemption amount from 25% to 50% of the amount by which the taxpayer's AMT income exceeds the threshold amount. Mortgage interest deduction. So the bill permanently extends the TCJA's provision limiting the Section Code 163 qualified residence interest deduction to the first $750,000 in home mortgage acquisition debt. It also makes a letter to the 4 Senate leaders. It also makes mortgage insurance premiums deductible as well. A letter to 4 Senate leaders dated June 28th reiterated the AICPA's appreciation for multiple provisions in the bill and noted the AICPA's continued concern regarding the permanency of the Tax Cuts and Jobs Act limitation on such deductions. And they said, quote, "We hope to continue to work with you to find improvements on this issue of any future tax legislation," the letter said. That being said, on balance, the legislation that the Senate will consider makes significant improvements to the OBBB, which is the One Beautiful Bill Act, that truly promote business growth. With that in mind, we express strong and current support for the Senate tax provisions and urge their inclusion in any final version of the BBB that becomes law. Miscellaneous itemized deductions. The bill makes permanent the TCJA's suspension of Section Code 67G deduction for miscellaneous itemized deductions, but removes unreimbursed employee expenses for eligible educators from the list of miscellaneous itemized deductions. And itemized deduction limitations. So the bill permanently removes Section 68, overall limitation on itemized deduction, known as the piece limitation, and replaces it with the new overall limitation on the tax benefit of itemized deductions. The amount of itemized deductions otherwise allowable would be reduced by 2/37 of the lesser of 1, the amount of the itemized deductions, or 2, the amount of the taxpayer's taxable income that exceeds the start of the 37% tax bracket. Bicycle commuting reimbursements. The bill permanently excludes qualified bicycle commuting reimbursements from the list of qualified transportation fringe and other commuting benefits, making them taxable to employees. Moving expense deduction. The bill permanently eliminates Section 217 deduction for moving expenses, except for members of the armed forces and certain members of the intelligence community. I find that interesting. Wagering losses. The bill amends Section 165D to clarify that the term, quote, losses from wagering transactions, end quote, includes any deduction otherwise allowable under Chapter 1 of the Code incurred in carrying on any wagering transactions. The bill limits the term losses from wagering transactions to 90% of the amount of those losses, and losses will be deductible only to the extent of the taxpayer's gains from wagering transactions during the year. ABLE accounts. The bill makes various changes to Section 529A. ABLE accounts, including making permanent the Tax Cuts and Jobs Act, increased limitation on contributions to ABLE accounts. The bill also makes permanent the inclusion of ABLE account contributions as eligible Section 25B saver credit contributions. But after 2026, only ABLE account contributor contributions will be eligible savers credit contributions. The credit amount increases from $2,000 to $2,100. This increase was not included in the Senate Finance Committee's version of the bill. Student loan debt discharge. All right, big one. The bill makes permanent and makes some adjustments to Section 108F5 provision excluding from gross income student loans that are discharged on account of death or disability. The bill also requires the inclusion of taxpayers' Social Security number on the relevant income tax return when a student loan is discharged. That's good. All right, no tax on tips. The bill provides a temporary deduction of up to $25,000 for qualified tips received by an individual in an occupation that customarily and regularly receives tips. The deduction will be allowed for both employees receiving a Form W-2 wage and tax statement and independent contractors who receive Form 1099-K, payment card and third-party network transactions, or Form 1099-NEC, non-employee compensation, or who report tips on Form 4317, Social Security and Medicare tax on unreported tip income. The deduction would be an above-the-line deduction and therefore available for taxpayers who claim the standard deduction or itemized deductions. The deduction begins to phase out when the taxpayer's MAGI, or modified adjusted gross income, exceeds $150,000, $300,000 in the case of a joint return. This temporary deduction will be available for the tax years 2025 through 2028, so it's not like forever right now. A transition rule will allow employers required to furnish statements enumerating an individual's tips for the tax year 2025 to use, quote, any reasonable method, end quote, to estimate designated tip amounts. No tax on overtime. So overtime pay is taxable income. That's the current law. The House bill allows deduction for qualified overtime compensation, excludes highly compensated employees and tips. Deduction ends after 2028. Social Security number required. And what was approved by the House and passed by the Senate was very, very similar, but it limits the benefit to $12,500 per year, subject to an income limitation. All right, car loan interest for the years 2025 through 2028. The bill excludes qualified passenger vehicle loan interest from the definition of personal interest in Section 163H. Qualified passenger vehicle loan interest is defined as interest paid or accrued during tax year on indebtedness incurred by the taxpayer after December 31st, 2024 for the purchase of, and that is secured by a first lien on, an applicable passenger vehicle for personal use. Pretty specific. Among other restrictions, applicable passenger vehicles must have had their final assembly in the United States. The exclusion is capped at $10,000 per year and will phase out for taxpayers with MAGIs in excess of $100,000, $200,000 for married filers filing jointly. Adoption credit. The bill makes a portion up to $5,000 of the Section Code 23 adoption credit refundable. That amount will be adjusted for inflation. Dependent care assistant programs. The maximum annual amount excludable from income from Section 129 dependent care assistant program increases from $5,000 to $7,500 under the bill. Child and dependent care credit. This is a big one. The bill permanently increases the amount of the child and dependent care tax credit from 35% to 50% of qualifying expenses. The credit rate phases down for taxpayers with adjusted gross income or AGI over $15,000. It will be reduced by 1 percentage point, but not below 35% for each $2,000 that the taxpayer's AGI exceeds $15,000. It will then be further reduced by, but not below 20%, 1 percentage point for each $2,000, $4,000 for joint returns that their AGI exceeds $75,000, $150,000 for joint returns. Trump accounts. This one is hilarious, but it's awesome for people having babies this year and over the next couple of years, so pay attention. The Senate version of the bill takes the House's bill concept of tax-free savings accounts for minors called Trump accounts and revises it to make them a form of individual retirement account or an IRA under Section Code 408A. Under the bill, Trump accounts will be IRAs, but not Roth IRAs, for the exclusive benefit of individuals under 18. Contributions can only be made in calendar years before the beneficiary turns 18, and distributions can only be made starting in the calendar year the beneficiary turns 18. Trump accounts will have to be designated as such when they're set up, and the bill does not allow Trump account contributions until 12 months after the date of enactment of the bill. Under the bill, Treasury can set up Trump accounts for individuals that it identifies as eligible and for which no Trump account has already been created. Eligible investments in Trump accounts would generally be mutual funds and indexed ETFs. Contributions other than qualified rollover contributions will be capped at $5,000 a year, adjusted for inflation after 2027. State, local, and tribal governments and charitable organizations could make, quote, general funding contributions, which would be contributions made to a specified qualified class of Trump account beneficiaries. Qualified classes include beneficiaries under the age of 18, and the general funding contribution can specify geographical areas or specific birth years of beneficiaries whose accounts will receive the contributions. The bill creates a new section code 128 that allows for employer contributions to Trump accounts. These contributions will not be included in the employee's income. Wow. Okay. A new section 6434 creates a Trump accounts contribution pilot program that provides a $1,000 tax credit for opening a Trump account for a child born between January 1st, 2025 and December 31st, 2028. So if you're going to have a baby, get on it. Get on this for sure. The bill appropriates $410 million to remain available through September 30th, 2034 to fund Trump accounts. Wow. Okay. Credit for contributions to scholarships granting organizations. Okay, so the bill enacts a new section code 25F that provides a credit of $1,700 for charitable contributions to scholarship granting organizations. Earlier versions of the article misstated the credit amount and included details of a cap on the credit that was in an earlier versions of the bill, but not in the final act. The provision also creates Section 139K, which excludes from income scholarships for the qualified secondary or elementary education expenses of eligible students. Charitable deduction for individuals who itemize. So, this update of the bill would limit the charitable deduction for taxpayers who itemize by providing a deduction only for the charitable contributions to the extent that they exceed 0.5% of the taxpayer's contribution base. So there you go. You'll have to there's more to that story. It looks like the bill imposes a 0.5% floor on the charitable contribution deduction. So the amount of an individual's charitable contributions for a tax year is reduced by basically 0.5% of the taxpayer's contribution base for the tax year. For corporations, the floor will be 1% of the corporation's taxable income, and the charitable contribution deduction cannot exceed the current 10% of taxable income limit. So keep that in mind, businesses. All right. Speaking of businesses, I'm going to pause here and we're going to dive into the business provisions of the big, beautiful bill. Stay tuned. All right. So we're down to the final run of the big, beautiful bill act, at least a summary of it from AICPA. So if you're looking for more information, reach out to your tax professional, your CPA, your tax attorney, that type of thing. But hopefully this has been educational. We still have the business provisions to go, so let's dive in. Bonus depreciation. The bill permanently extends the Section Code 168 additional first-year bonus depreciation deduction. This allowance is increased to 100% for property acquired and placed in service on or after January 19, 2025, as well as for specified plants planted or grafted on after January 19, 2025. Section 179, expensing. The bill increases the maximum amount a taxpayer may expense under Section 179 to $2.5 million, reduced by the amount by which the cost of qualifying property exceeds $4 million. Research and development expenses. The bill allows taxpayers to immediately deduct domestic research and experimental expenditures paid or incurred in tax years beginning after December 31st, 2024. However, research or experimental expenditures attributable to research that is conducted outside the United States will continue to be required to be capitalized and amortized over 15 years under Section 174. Small business taxpayers with average annual gross receipts of $31 million or less will be generally permitted to apply this change retroactively to tax years beginning after December 31st, 2021. And all taxpayers that made domestic research or experimental expenditures after December 31st, 2021 and before January 1st, 2025 will be permitted to elect to accelerate the remaining deductions for those expenditures over a 1 or 2 year period. Limitation on business interest. The bill reinstates the EBITDA limitation under Section 163J for tax years beginning after December 31st, 2024. Therefore, for purposes of Section Code 163J, interest deduction limitations for these years, adjusted taxable income would be computed without regard to the deduction for depreciation, amortization, or depletion. The bill would also modify the definition of motor vehicle to allow interest on floor plan financing for certain trailers and campers to be deductible. Paid family and medical leave credit. Under the bill, Section 45S is amended to make the employer credit for paid family and medical leave permanent. Special depreciation allowance for qualified production property. The bill allows an additional first-year depreciation deduction to equal 100% of the adjusted basis of the qualified production property. Qualified production property is generally non-residential real property used in manufacturing. So take note of that. Advanced manufacturing investment credit. This is interesting. Under the bill, the advanced manufacturing investment credit rate increases from 25 to 35% effective for property placed in service after December 31st, 2025. The Senate Finance Committee's version of the bill had proposed increasing the rate to 30%. Spaceports. This is interesting. The new bill, Section 142A1, to ensure spaceports are treated like airports under the exempt facility bond rules. A spaceport is defined as a facility close to a launch or reentry site that is used to manufacture, assemble, or repair spacecraft or space cargo, or is used for flight control operations to provide launch or reentry services, or to transfer crew, space flight participants, or space cargo to or from a spacecraft. This is a new provision that was not in the Senate Finance Committee's version of the bill. Employer provided child care credit. So the bill increases the amount of qualified child care expenses taken into account for purposes of Section 45F, employer provided child care credit, from 25% to 40%. The maximum amount of the credit increases from $150,000 to $500,000, $600,000 for eligible small businesses, and will be adjusted for inflation. Opportunity zones. The bill makes opportunity zones permanent, but with several changes, including narrowing the definition of low-income community. The changes would generally take effect January 1st, 2027. New markets tax credit. The bill makes Section Code 45D new markets tax credit permanent. Percentage of completion method. So the bill provides an exception to the Section 460E requirement to use the percentage of completion accounting method for certain residential construction contracts entered into after the date of the bill's enactment. Clean energy incentives. The bill terminates a large number of clean energy tax incentives. Section 25E, previously owned clean vehicle credit, terminates after September 30th, 2025. A lot of these do 25 and 26. There's like different dates, but I'll just kind of run through them. Section 30D, clean vehicle credit. Section 45W, qualified commercial clean vehicle credit. Section 30C, alternative fuel vehicle refueling credit. Section 25C, energy efficient home improvement credit. Section 25D, residential clean energy credit. Section 179D, energy efficient commercial buildings deduction. Terminates for property of the construction which begins after June 30th, 2026. Section 25L, new energy efficient home credit, terminates after June 30th, 2026. Section 45V, clean hydrogen production credit, terminates after January 1st, 2028. And Section 6426K, sustainable aviation fuel credit, terminates after September 30th, 2025. So there, you can look these up, but there's a lot of them that are canceled. I think that Elon Musk was upset about that. The Section 168E 3B 6 provision allowing cost recovery for certain energy, property, and qualified clean energy facilities. Property and technology will be terminated after December 31st, 2025 for energy, property, and after the date of enactment for qualified clean energy facilities, property, and technology. The bill places restrictions on claiming the Section Code 45U nuclear power production credit for foreign entities and for facilities that use imported nuclear fuel. The Section Code 45Y clean electricity production credit is terminated for wind and solar facilities placed in service after December 31st, 2027. No credit will be allowed to facilities that are owned or controlled by certain foreign entities. That seems to make sense. The SEC or the Section Code 48E clean energy, the Section 48E clean electricity investment credit is also terminated for wind and solar facilities placed in service after December 31st, 2027. Restrictions are also placed around claims by facilities owned or controlled by certain foreign entities. The Section Code 45Z clean fuel production credit is extended through 2029, and prohibitions are placed on the use of foreign feedstocks, FYI. International provisions. So, foreign tax credit limitation. The Senate Finance Committee's version of the bill would have limited the deductions of the U.S. shareholder applicable to income in the Global Intangible Low Tax Income, or GILTI, category when determining its foreign tax credit limitation. It would also have modified the determination of deemed paid taxes, properly attributed to tested income, and changed the rules for sourcing certain income from the sale of inventory produced in the United States. The adopted bill revises that provision and treats those deductions as applicable to net CFC tested income, which is what the bill turns GILTI into. And there's more on that down the road, but I won't go into it here. Deemed paid credit. The bill extends Section 960D1 to increase the deemed paid credit for Subpart F inclusions from 80% to 90%. Remedies against unfair foreign taxes. The provision of the Senate Finance Committee's version of the bill that would have ended a new Section 899 code to impose increased rates of tax up to 15% on certain affected taxpayers connected to countries that are deemed to impose unfair foreign taxes was dropped from the final bill. So, let's dive in. Administrative provisions and excise taxes. Let's go over that. Third-party network transaction reporting threshold. The bill reverts to the prior rule for Form 1099-K reporting, under which a third-party settlement organization is not required to report unless the aggregate value of third-party network transactions with respect to participating payee for the year exceeds 20,000 and the aggregate number of such transactions with respect to a participating payee exceeds $200. The threshold had been phasing down and was scheduled to be $600 starting next year. Form 1099 reporting threshold. The bill increases the information reporting threshold for certain payments to persons engaged in a trade or business and payments of remuneration for services to $2,000 in calendar year from $600. The threshold amount to be indexed annually for inflation in calendar years 2026 and after. Firearms transfer tax. The bill reduces Section 5811 transfer tax on certain firearms. That's good. Farmland sales. The bill adds a section code 1062 that allows income tax resulting from the sale of farmland to a qualified farmer to be paid in 4 annual installments. This is a new provision of the tax code. It's pretty cool. Litigating financing. So the bill, as originally considered, would have imposed a 31.8% tax on, quote, qualified litigation proceeds, end quote, received by a covered party. As defined by the bill, the provision was dropped from the final bill, which is good. Remittance transfer tax. The bill imposes a 1% tax on remittance transfers imposed on the sender. A remittance transfer for these purposes is a transfer of cash, a money order, cashier's check, or similar physical instrument. It does not include funds withdrawn from an account held with a financial institution or charged to a credit or debit card. Under Section 919G of the Electronic Fund Transfer Act, a remittance transfer is an electronic transfer of funds requested by a sender to a designated recipient that is initiated by a remittance transfer provider. A remittance transfer provider is any person or financial institution that provides remittance transfers for consumers in the normal course of its business, whether or not the consumer holds an account with the financial institution. The Senate Finance Committee's version of the bill would have imposed a 3.5% tax on such transfers. Whew. Man. Employee retention credit enforcement. So the bill requires employee retention credit promoters to comply with the due diligence requirements with respect to a taxpayer's eligibility for or the amount of an ERC. This bill applies a $1,000 penalty for each failure to comply. It also extends the penalty for excessive refund claims to employment tax refund claims. It also prevents the IRS from issuing any additional unpaid claims under Section 3134 unless a claim for a credit or refund was filed on or before January 31st, 2024. Social Security number requirements. I love this. The bill imposes an SSN requirement for claiming an American Opportunity or Lifetime Learning Credit under Section 25A. Yeah, one would think that would already be there. EITC program. The Senate Finance Committee's version of the bill proposed creating an Earned Income Tax Credit, EITC, certification program to allow the IRS to detect and manage duplicative EITC claims. That proposal was dropped from the bill. Penalties for unauthorized disclosure of taxpayer information. A proposal in the Senate Finance Committee's version of the bill increased the section code 7213 penalties for unauthorized disclosure of taxpayer information was also removed. So, Alistair Nevis, JD, he's a freelance writer in North Carolina, and he wrote this article for the AICPA. I want to give a shout out to you. Well done. Updates on individual tax and business tax are among many topics of the agenda of the AICPA and the CIMA National Tax Conference coming up November 17th and 18th in Washington, D.C. and online. So if you have any questions, speak to your designated tax professional, a CPA, an accountant, stuff like that, or reach out to your financial advisor community to learn more. And we're all trying to get caught up on what just happened and how that impacts your financial future. Thanks for tuning in. I know this was a long one. Thanks for hanging in there, and share with your friends this update on the one big, beautiful bill. For that, have a great rest of your week and weekend. Take care.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.